Hey gang, this is David Littlejohn joining me today in our homemade studio with Matt today. This is March 13th. We're doing a special edition here. I don't normally like to put the date on something because as soon as we do that, then it's really relevant for this time. And if you're watching it a year from now, you're going to go, huh. But if you've not paid attention recently, one, that's okay. But two, if you have, you're probably thinking to yourself, are we having a banking crisis? And I wanted to talk a little bit about that today. I put the whiz kid on it. I shouldn't say that since he's not a kid. But anyway, Matt, thanks for doing a bunch of homework on, can you walk us through, this all started with Silicon Valley Bank last week, and it's kind of quickly taken on a life of its own. But can you just give us a quick summary of what happened?
Yeah, so timeline-wise, what happened was Wednesday rolled around, and Silicon Valley Bank decided that they needed to release some news to the public saying that they were about $2 billion.
That's billion with a B.
Yeah, billion with a B.
Okay, so like a little bit.
Just a tiny bit of money.
Okay.
They needed to raise some capital, and so they sent out a press release, and it caused a little bit of a panic with some of the people that were invested at the bank. And that same day, two big venture capitalist groups decided to email people that had startups with their bank that they should probably pull their money because of this newsletter that the bank sent out. Fast forward to the end of the day.
Yeah, about less than 12 hours, I think.
Yeah, there was a big run on the bank, and basically what that means is people went to the bank and said, hey, we want our money. And the following day, we see the bank moving to liquidate a lot of their short-term and long-term debt holdings. And as a result, they had to sell things at a big loss.
Yeah, so let me unpack this just a little bit more for context. Banks operate under what's known as a fractional reserve system. So if you put your money on deposit in the bank, they don't leave it all in a vault somewhere, they lend it back out. But they have to have a certain amount on hand in case people come to redeem, right? And they had bigger than expected redemptions because of this group of venture capitalists that said, hey, we don't think we like what's going on within the bank. So that's the run on the bank, was this big group of folks that came all at once and said, we would like our money now. It was further stressed though because the money they had on hand wasn't just sitting in a vault. They had purchased bonds that they were using as collateral for their account holders. But those bonds are interest rate sensitive. You want to talk about that for a second?
I think a lot of people could relate to this because maybe you refinanced a house at a low interest rate.
Right.
And so as a lot of people flocked to those lower rates, the banks took on a lot of obligations at those lower rates. And then when the rates moved higher, those bonds and debt obligations were worth less because they had to sell them at a loss.
Yeah, it works this way, right? Think about for a moment a bond or a fixed income instrument when you're the one that buys it, right? Like if you go to the government and say, I would like to buy a treasury bond, what you're effectively doing is saying, I'm going to give a loan to the government, and then when that loan is up, they're going to give me my money back in a balloon payment, and along the way, they're going to pay me interest payments. But you don't necessarily have to stick with that loan for the whole life of the loan. Let's say I choose partway through the duration of that loan that I'd like to sell it and move on to something else. Somebody could buy that loan from me. So maybe Matt wants to buy the loan. He's going to look at the current interest rates, compare them to what the bond was when I started, and if rates have changed, he's going to change what he's willing to buy that loan to me from me rather. So if the rates are higher today, my loan doesn't look very good because it's got a low interest rate. So he's going to probably pay less than what I paid for the loan. He'll expect to get the interest rate I signed up for, and then he's going to get some of the appreciation when the balloon payment comes. He's going to get some of that balloon payment as part of his return. But if the rates go up when I'm holding the bag, then the value of that instrument that I own will drop in the marketplace.
And SVB was holding a big bag of loans at really low interest rates, and when they had to offload them, they realized a $1.8 billion loss.
Yeah, they had collateralized their account holders in bond instruments that lost money as the Federal Reserve has been raising rates to fight inflation. And so that put them at a deficit balance. When they sold in order to make these redemptions, that caused a huge loss on their balance sheet. And it basically broke the rules for reserve requirements for the banks. And so we saw the California regulators and then afterwards the FDIC step in and say, we got a problem. Now, what has happened since then, Matt?
Well, the good news is the government stepped in and they actually made all of the people who were banking there whole. So they said, you're not going to lose money here. We're going to make sure that you're taken care of.
Right, and I think that's important for everybody to take away here is this isn't a bailout in the sense of they're allowing Silicon Valley Bank to go under.
Well, this is a lot different than 2008 because in 2008 there was a bailout. Here, there isn't.
It's not a bailout in this case. What it is they are backstopping the bank account holders. So the people that had money in the bank, what they're saying is your money is going to be made whole. The bank is going to be allowed to experience the natural consequences of the marketplace, and they're not going to be around anymore. I think this is an important distinction for everybody to pay attention to because what it's saying is the government has said we need to make sure that the integrity of the banking system is unshakable. So nobody needs to worry about whether or not their money is safe in a bank. But we also need to hold banks accountable to the regulations and the behavior of being healthy banks. So it's definitely rippled through the system. We saw extraordinary trading activity on both last Friday and then yesterday, which was Monday, March 12th of 2023.
There was a lot of concern. We saw a lot of banks that weren't even involved in this. Their share prices went down. But then today, we saw it rebound because the market is trying to determine where this thing is at. And it's indicating that there actually might be a lot of optimism. Yeah,
so this is the silver lining to all of this. I mean, and this, just stay with me for a second. This is going to seem weird and maybe a little Pollyanna-ish, but the Federal Reserve, we also got a key data point that was released today that said CPI, the Consumer Price Index, came in for the last 12 months at 6%. That's still higher than they would like to see.
But it's lower than it has been.
Right, it's much lower. So the path now is that inflation is starting to wane. And it doesn't mean that the Federal Reserve's work is done here. They've been raising interest rates to combat inflation for a year now. But what it suggests is two things. One, they're less likely to be as aggressive going forward because it looks like it's working. So they may take a little bit more of what they call a dovish or soft-handed approach to interest rate hikes for a little while. And so that's good news for the market because it stabilizes pricing. And then it also suggests that they are maybe encouraged to be more dovish because they don't want to create more turmoil on bank balance sheets.
They don't want to keep stressing.
Yeah, they keep raising rates, and they make it hard on the bank bond portfolios themselves, and so it's tough on bondholders, and that ripples through the system. So in a sense, they're a little boxed in here. But if they're boxed in while inflation is coming down, it's possible that this thing it's not going to turn into a contagion that turns into a 2008. And for what it's worth, I realize it's just my opinion as one analyst compared to any out there. I don't think that the probability of this mass contagion is really high. I've been saying this for a while. I don't think it's a 2008 style event. Right? I think this was a shakeout. And let's be really careful not to conflate stock price movement with bank balance sheet safety, right? Just because a bank sold off yesterday, many of them are recovering significantly today, doesn't mean that all hope is lost or that we have an imminent collapse of the banking system.
Well, and you brought this up right as you saw all of this happening. You're like, hey, this might just be a little bit of a reconfiguration where some of the smaller banks are just going to be absorbed by bigger banks.
Right.
And we've kind of seen that already happening, where the regulators gave investors the option to move their assets to a bigger bank.
Yeah. So that could certainly happen, and I don't even know that that's going to happen. This is more, you just hang around with me for a while. Every now and then pull out my tinfoil hat and suggest things like, perhaps regulators don't want as many banks to worry about, so they're okay with some consolidation. Personally, I like consumer choice. I like community banks because I think you get that personal relationship-driven banking. It's not to say that the big banks are bad or anything like that, but I think that they play a key role in the system for lots of different reasons. But nevertheless, the key takeaway for me is going to be, for now, it does not appear that this is a calamity event and that we all need to head for the hills. I reserve the right to be wrong, okay? But the data just doesn't indicate that right now. And so I think in the end, just having a cooler head and taking a little time to digest this, the markets seem to be shaking it off. And my suspicion is that by this Friday, Silicon Valley Bank will be more of a footnote to the news cycle than it will be the front page of the news cycle. So we shall see.
That seems fair.
Yeah.
Good deal.
Yeah. So anyway, we just want to take a moment. Matt, thanks for doing homework. I do want to give him credit too. He really got into the weeds, tracked down the numbers, where it came from. I mean, he could give you a whole dissertation. If you're interested in hearing more, tune in today. We're going to do the radio show at 4 p.m. today on KQEN. And if you're watching this after that already happened, it gets podcasted as well. So you can grab that on the webpage, go under the podcast section, and you can pull that up for, again, it's March 13th today, right? Mm-hmm. So anyway, anything else for the good of the order?
I think that basically covers it.
Good deal. Well, as always, if you've got questions or concerns, please don't hesitate to reach out. How do they reach us, Matt?
Give us a call at 541-375-0898 or send us an email at info@littlejohnfs.com.
Yeah. Or you can have Matt's personal cell phone number.
Yeah, that is. No.
All right. We got him down there on the video and all that. Thanks as always, Matt. Yep. Until next time, Dave Littlejohn.
And Matt Dixon.
And we'll catch you later. See ya.